Good morning, everyone. This is live daily market outlook from Windsor Brokers for Wednesday, 3rd of April 2013. Pardon. The markets are gaining speed ahead of some important releases seen this week. We have the central banks commencing as from tonight. The Bank of Japan kicks first, and then tomorrow we have Bank of England and the European Central Bank with the most of market focus seen on these events that might give us some more hints and the directions of the near-term trading. Yesterday's movements could be described in the only one word: reversal. Most of instruments basically reversed, nearly fully reversed their recent past 2 days movements. With the starting with euro that dipped from yesterday's high at 128.75 as low as 127.88, cracking support at psychological support at 128.00, while the sterling was among the top losers on the sharp slide from 152.56, leaving double top and extending losses to 150.73, the low seen this morning. Also, one of the top losers was the gold after breaking through below the triangular consolidation, sharply fell lower through some supports, hitting so far 1563. Now this increases again downside pressure and risk for possible revisit of the critical support for the gold multi-year range floor at 15, 20, 30 zone, with negative outlook in the near term, still favoring the downside. From the other currencies, currency pairs, dollar yen regained some ground of yesterday's low at 92.56, basically retraced 61.8% of the latest down leg from 94.36 to 92.56, but still overall negative tone still keeps the downside pressured, while the Aussie dollar against the US dollar holds its positive tone, consolidating recent gains that were capped yesterday at 104.78, with the prevailing positive tone still keeping the upside focused. From fundamentals that we have today, already released. The important release was the Australian trade balance during the Asian session that came in much better than forecasted. The gap was 178 million compared to the forecasted 1 billion gap, and 1.06 billion, pardon, release in January. Chinese non-manufacturing PMI came better in March. 55.6 was March release compared to 54.5 figures seen in February 2013. Still to come, UK's construction PMI for March, 47.7 is forecast, above the previous February's release at 46.8. Estimation for the inflation of in Eurozone for March is seen at 1.6 compared to 1.8 in February, slight decrease in the inflation on the year-on-year result. And then we have the ADP non-farm employment change for March from United States, due at 12:15 GMT, 203,000. It's today's forecast. It's around the previous release of 198,000. This is one of the initial indicators for coming U.S. non-farm payrolls data that are due on Friday, and so far, according to expectation to ADP data, there will be no significant changes according, if we take this as initial indicator. 1400 GMT, we have US ISM and non-manufacturing PMI for March, 55.9, slightly below the, is forecast slightly below the February's release at 56. US crude oil inventories weekly release come at their regular time at 14:30 GMT. 2.3 million barrels build is seen in the past week compared to the previous week's build of 3.3 million barrels, and that these are the most significant releases for today from fundamentals. Reminder again that the most interesting things are still to come. The next evening, next night, we have a Bank of Japan, and then tomorrow we have European Central Bank and the Bank of England releases that will likely bring some more action in the markets near-term movements. Starting technicals with the euro-dollar as shown on the near-term chart. Let me just open the chart for you. We are in the hourly chart. Okay, you can see, as we can see, the yesterday's rejection at 128.75, that also marks 200 days moving average that capped the upside, has triggered fresh weakness. Break below this morning's, yesterday's, basically overnight's cracking 128 support, which is also 61.8% Fibonacci retracement of the corrective rally from 127.50 to 128.75, sees the downside now more pressured as our indicators are negatively aligned and well positioned for further extension lower, with a similar situation seen on the 4-hour chart, as indicators did not leave except a slight momentum being gained on the rally from last Monday's low at 127.70 to 128.75. Most of indicators are again in the negative, negatively positioned, and they see potential for further easing lower, although the current recovery of 127.50 still faces support at 127.70. That current pullback is approaching. Break below here is definitely to confirm the negative tone and open initially 127.50 for a possible extension, lower extension of the larger downtrend from 137.10 1st of February annual high, with the 127.00 seen as a next round figure support ahead of a more significant 126.79, 61.8% retracement of the larger 120.42 to 137.10 rally, and the higher low of November 2012 at 126.60. These two are seen as the next downside targets, according to the daily structure that shows the bears now firmly in play and looking for possible further retracement, especially that the pair broke below 50% retracement. That also marks 200 days moving average and now firmly holds below these levels. That keeps the downside pressured for now. Similar situation is with the sterling dollar cable that lost, retraced, basically fully retraced the recent rally from last week's low at 150.95 on today's dip to 150.73. Yesterday's sharp fall following upside rejection at 152.56. That is just ahead of a previous high at 152.59, marks now double top bearish pattern that sees potential that already triggered the fall through 150.91, 150.73 seen so far. Some corrective action is now seen on oversold pardon, hourly conditions, as RSI is already out of the oversold territory. For now, I would say that corrective action is seen limited, as the 4-hour indicators maintain positive, maintain negative tone, and we see the 151.43.65 zone. These are the Fibonacci 38.2 and 50% retracement of the downleg from 152.56 to 150.73, along with the descending 55 days exponential moving average, as seen as a limit for the recovery. Otherwise, alternative scenario will see break above these two levels, especially the 50% at 151.65. That might imply further range trading that has been recently established, range defined on the downside by lows 150.91 for 150.73. On the upside, we have the double top at 152.59.56. In case of stronger reversal above 152.50.60 barriers, then we'll be talking about expansion in the near term of the range trading. However, as I mentioned, they quite negatively aligned near-term studies still see more focus towards the downside, and after the corrective action is completed, the possibility of further slide are quite high, with the break below 150.73 expected to focus. Next significant support 150.45, which marks 50% retracement of the recovery rally from 148.30 to 152.59. Dollar yen, as we said again, there's some ground following yesterday's dip to 92.56, where the temporary support was found, and then bounce higher, retraced exactly 61.8% of the entire down move from 1st of April high at 94.36 down to 92.56 yesterday's low, where the gains were limited. This is also the area of the previous low that was at 93.52, as well as 20 days exponential moving average of 4-hour chart that offers quite good resistance here for now, with subsequent easing now being underway. The main risk on the downside will be seen on the loss of I would say 93.25 and then 93.00. That would confirm the lower top at 93.67 and refocus the downside initial support at 92.56 ahead of another significant level set 92.00. This is the previous low. We have interim support 76.4% retracement at 92.23, along with the daily 55 days moving average at 92.56. Basically, this was the limit of the losses from the recent losses at 92.56, where the losses were limited by 55 days exponential moving average. More risk will be seen towards the downside. 92 previous range floor will come in focus. Conversely, bounce above 93.67 would require a regain of minimum 94.00. Prefer this break above 94.35. There is a recent consolidation top in order to shift focus higher and avert immediate downside risk in favor of some stronger recovery. But for now, this looks quite unlikely. Of course, a lot depends on tomorrow's release of Bank of Japan, with most of comments saying that most of the action that will be taken from Bank of Japan has already been priced in, and the most likely scenario will be further easing of dollar yen. Of course, we're going to see it after the release of Bank of Japan rate and the policy decision. But for now, the negative tone that dominates on the lower time frames studies keeps the downside more focused at this point, as well as daily studies that are in descending mode and attempting below their midlines, keeping the downside favored for now. Aussie dollar holds its near-term positive tone. Basically, the pair is consolidating recent gains of 1st of April's low at 103.85, as the pair jumped as high as 104.78, retracing over 76.4% of the entire 104.96, 103.85 descent, with gains being limited so far there. But from the downside, the corrective pullback was contained at 104.40. That marks 50% Fibonacci retracement of the 104.96 to 103.85 descenders, and 55 ascending 55 days exponential moving average that contained the dip so far, keeping the upside focused. This morning we have a fresh strength that is attempting again towards 104.78. Overall picture, as I said, is still positive and keeps the upside focused, with the more room towards the upside seen on the improved 4-hour indicators, 4-hour studies that see the retest of 104.96, 105.00 as the next step, with the break above this level as seen as a trigger for extension, fresh resumption basically of the larger recovery rally from 101.14, 4th of March low, for possible full retracement of the down leg from 105.97 January's annual peak down to 101.14 March annual low, with the positive tone seen on the daily chart, keeping the upside for now favored. On the downside, the risk will be seen, increased risk will be seen on the loss of 104.40, and basically break here with the risk further extension lower, where we'll have the Fibonacci levels at 104.30 and 104.20 that are 50 and 61.8% retracement of the recovery rally from 103.85 to 104.78, and basically break below these two levels would bring increased downside risk for possible break below psychological 104.00 support and extension down towards our key near-term support at 103.85 low of 1st of April 2013. And one of the top losers yesterday is gold, as we can see the sharp fall after breaking below triangular narrowing range consolidation. We mentioned yesterday in our analysis that despite holding a sort of neutral tone on the hourly chart, more negative signals were seen on the hourly and the 4-hour chart, and this resulted basically in a break below the range support, the range floor, and the triangle support at 1590 zone that triggered sharp fall. So far, reaching 1563. This was the low of this morning, with further extension lower seen quite likely at this point. Hourly indicators are negative, well in the negative territory, and well extended, so we can expect some consolidative corrective action as RSI is starting to point higher. MACD is still not giving any firmer signals of reversal. Momentum is pointing higher, and stochastic too, but still no clear signal given so far. We need to see a gain on the upside of minimum 1577. This is the yesterday's, overnight's high, as well as previous support, break of which would bring us some more positive tone, but the recovery so far seen limited as the entire down move from recent high at 1616 posted on 21st of March down to today's low at 1563 requires regain of minimum 1590. That marks previous range floor and 50% retracement of the entire move in order to improve the structure. Otherwise, more risk will be still seen towards the downside, as break below 1561, 1563 and 1561 low of 8th of March would risk test of our key near-term support at 1554 low of 21st of February 2013, and possibly to extend losses towards the critical support at 2030 zone. This is the multi-year low since 2011 range floor, a break of which will be a trigger for some more significant corrective action of the over 10-year bullish rally of the yellow metal. And finally, the crude oil. If we take a look on the hourly chart, we are still in a sort of sideways movement consolidation, with downside being protected at 96 zone. This is the previous low of 1st of April. Yesterday revisited again without break lower, exactly the same level, and the bounce higher, keeping the price currently within the 95.90 and the 97 50-60 range, with the near-term structure, hourly structure, slightly skewed towards the downside. But as long as we are holding above 95.90, further range trading could be anticipated. Positive tone on the 4-hour chart seems to be losing a pace as indicators are descending, and the price is now attempting below the 20 days exponential moving average. Of course, confirmation will come on a break below 95.90. 95.70, that is 23.6% retracement, and the 93.55, 55 days exponential moving average. That will bring a confirmation of possible further easing, further reversal of the recent rally from 89.35 to 90. 97.68. As said, the 4-hour indicators are running out of steam and losing initial bullish momentum. We see the more near-term risk towards the downside with levels as mentioned 95, 90, 95, 70, 95, 55 ahead of a more significant 94.50 previous peak and the 38.2% Fibonacci retracement of the entire rally from 89.35 to 97.68. Daily structure is more positive at this point, and the bulls from 89.35 remain now fully in play, with current pullback seen as the corrective action, and that would allow dips down towards 95.00 without harming the bullish tone for possible stretch higher and possible full retracement of the short-term descent from 98.63 13th of February peak down to 89.35 4th of March low to complete this corrective phase, and likely to establish a fresh uptrend from 89, extend the fresh uptrend from 89.35. Basically, the crude oil, if we take a look at the weekly chart, is forming a triangle on the consolidation. Is forming a triangle on the rally from 977.27. This is 2012 low, with the upside barrier triangle resistance is now coming under increased pressure, and break here is to signal fresh direction. That in this case will be a resumption of the bull tone from 89.35 and the larger picture from 84.05 low of November 2012. Overall, a positive tone, as I said, keeps the upside focused, with the current easing seen as corrective. That was all for today from me. I wish you a nice day and, of course, successful trading, and expect to see you back tomorrow morning at the same time at 7 o'clock GMT, 10 o'clock local Cyprus time. Good luck.